It's 2026. Everyone is still talking about co-living like it's the golden strategy. Convert into one unit, split into multiple rooms, double your rental income. But here's the uncomfortable truth. Many people entering into co-living today are actually using outdated assumptions. And if you don't understand what has already changed, you might not just underperform, you might actually lose money. So today, I'm going to break this down properly. No hype, no surface level advice, no cost to sell you. Just real numbers, real risk, and what actually works in 2026. Let's first align on what co-living actually is. Because despite how it's marketed today, this concept isn't new. At its core, co-living comes from a very simple idea: taking one large space and breaking it into smaller, rentable units. If you think about it, this already exists in several other industries. Trade shows subdivide exhibition halls into booths, co-working spaces like WeWork lease desks within a larger office. Co-living is essentially that same model applied to residential property. But here's the key shift most people overlook. You're no longer treating the property as a home. You're operating it like a business. Instead of renting out the entire unit to one tenant, you rent out individual rooms. And in many cases, you go a step further by reconfiguring the layout, creating additional rooms through partitioning or optimization to maximize rental yield. Here's a typical example. A normal 3-bedroom unit might rent out for about $4,500. But if you rent rooms individually, a master bedroom may fetch you $2,000 plus. Common rooms go for $1,200 to $1,500 depending on your location, and you're already around $5,000 total. Now, if you optimize this layout into 5 or 6 rooms, you could be looking at $8,500 to $10,000 revenue. And this is where most people stop thinking. They see the upside, but they don't analyze the full structure. To understand today's reality, we need to first understand why co-living worked so well before. Because what most people saw was the profits, but what they missed was the timing. This wasn't just a good business model, it was the perfect environment back then. Right after COVID, the rental market didn't just recover, it overcorrected. Borders reopened, expats flooded back in, companies resumed hiring, but supply simply couldn't keep up. Construction delays from COVID meant fewer new homes were completed. At the same time, many homeowners were actually holding back from renting, waiting for prices to stabilize. So what happened? Demand spiked, supply stayed tight. Rents surged across the board. And this is where co-living operators benefited disproportionately. Because when you rent by the room, you're effectively multiplying your exposure to rising rents. Even poorly executed units, bad layouts, average locations could still turn a profit. Not because they were good, but because the market was doing the heavy lifting. Low competition. At that point in time, co-living wasn't mainstream yet. Very few people were doing this properly. There were only a handful of serious operators. Names like Cove, Collywoo, Habit. They had systems, branding, operational structure. But beyond that, the market was wide open, which is why you saw a wave of new entrants. Everyday investors started registering companies, renting entire units, sometimes multiple units at once, and converting them into co-living setups. The barrier to entry felt low. No need to buy property, just lease, renovate a bit, and sublet. And because demand was so strong, even average setups could hit high occupancy rates. So from the outside, it looked simple. Almost too simple. Wide margin gap. This is the most important piece. Revenue was rising much faster than costs. Let's break it down. Your master lease cost, locked in earlier, was relatively stable, but room rents were climbing aggressively month after month. So your spread widened. Here's an example. You rent a 3-bedder for $4,000. After partitioning, back then you could generate $10,000 to $12,000 in total room rent. That difference, after costs, looked like easy profit. And because this gap existed across many units, operators scaled quickly. They took on more leases, more units, more risk, without fully realizing it. And this combination of factors created a very dangerous narrative that co-living was scalable, low risk, and more importantly, easy money. But in reality, it wasn't the model that was easy. It was the market that was forgiving. Now, this is where we come back down to reality, because this is the part most people are missing. It's the exact reason why some operators today are quietly bleeding cash on every unit they hold, and month after month we're seeing operators close. What worked before doesn't work the same way anymore. And there are 4 major shifts driving this. Number 1, revenue has stabilized. The first shift is on the revenue side. Rental growth hasn't collapsed, but it has clearly slowed. In some segments, it's already plateauing. And this changes everything. Because previously, you could rely on raising your rents to fix mistakes. Underperforming unit, just wait it out. Market goes out and you'll recover. But today, that safety net is no longer there. Now, your rental assumptions need to be grounded in reality. You can't underwrite your deal based on future upside anymore. You need to ask yourself, if rents don't move for the next 12 to 24 months, does this deal still make sense for you? Because if your answer is no, then the model itself is already too tight. Number 2, costs have increased. This is your margin compression. Let's talk real numbers. Utilities alone today cost between $400 to $600 per month. Cleaning takes you $80 to $120 per week. Aircon servicing, repairs, replacements, furniture wear and tear, maintenance on poorly done renovations, and agent fees. And if you're owning, MCST and property tax, the non-owner occupied one, also comes into play. These are not a nice to have. These are required to keep the unit running. And number 3, the competition is real now. Market has hit its maturity. This is the biggest structural shift. Before, you were competing with very few players. Now, everyone has seen the same strategy. Everyone has attended the same causes. So, what changed? More co-living units are entering the market. More professional operators with better systems, better designed, better furnished, and better managed units. And more importantly, tenants now have options. This means that the power has already shifted. You're no longer pricing based on what you want to achieve. You're pricing based on what the market is willing to accept. And if your unit is not competitive, it simply won't get taken up. And vacancy is where your profits slowly disappear. Number 4, it's operational, not passive. This is where your execution risk comes in. Many investors get caught off guard by this because co-living was marketed so aggressively as passive income. But in reality, it behaves much closer to a hospitality business. You're not managing one tenant, you're managing 5 to 8 individuals with different lifestyles, different expectations, different tolerance levels, and conflicts do happen. Maintenance issues comes up, your turnover is frequent, and if you don't have proper systems in place, this will become extremely time intensive. Your hidden cost is not just money. It's your time, your attention, and your ability to manage people. So when you put all 4 shifts together, you start to see the real picture. Revenue is no longer expanding. Costs are rising. Competition is much stronger. And operations are heavier. Which means today, co-living is no longer an easy money strategy. It's a tight, execution-heavy business model. And if you don't run it properly, it will punish you. Let's run through a realistic scenario. Because this is where a lot of people get misled. They look at headline revenue and they don't understand what actually drives your profit. Scenario number 1, lease to sublease. This is where you pay a monthly rental to the landlord. For this example, we're going to use $4,500. Your revenue still is $8,500 per month. Let's break down your capex. For your capital expenses, you need to take into account your renovation costs, putting up your partitions, segmenting your spaces, rewiring your lightings, putting in new ACs, buying new furnitures. All that comes up to about $40,000 to $50,000. The vacancy buffer period, the time that it takes for you to fill all 6 rooms, we'll estimate it at 2 to 3 months. Here's your total expenses. It's $51,250. This is a one-off cost. Now, let's talk about operational expenses or your OPEX. For OPEX, I'll cap your utilities at $400 per month and your cleaning at $360 per month, Wi-Fi subscription at $30 per month, AC maintenance at $180 per quarter or $60 per month. Agency fees comes into $355 per month, and your total expense is $1,205 every month. This is a recurring expense. Your total time taken to break even will be an estimated 18 to 19 months. Your net monthly profit works out to be $2,795 a month. Now, reality check, this is assuming perfect conditions, which means 100% occupancy after stabilization, no major repairs, no rental drop, and smooth tenant turnover. But here's what happens in reality. If even one room is vacant, that's a $1,200 loss. Your new profit is now $1,600 per month. Your break-even becomes 32 months or 2.6 years. If 2 rooms are vacant, your profit is almost entirely wiped out. With 3 vacancies, you're now paying your rent to the landlord out of pocket in cash. That's the truth about lease to sublease. Tight margins, high sensitivity, and very little room for error. You're not investing, you're just running a very fragile business. And that's why smarter investors today are making a shift, not away from co-living entirely, but away from building it from scratch. Scenario number 2. Owning a ready-made co-living apartment. Let's use the same revenue at $8,500 per month, but a completely different structure. Your mortgage is $4,500. Your OPEX is $1,805, and your net cash flow is $2,195 per month. Sounds lower? Look deeper. Half of your mortgage actually goes into paying your principal. That's $2,250 per month that goes back into your equity. You'll get back this money when you sell the unit. Your true gain is actually $4,445 per month. Let's look into the capex now. For renovation costs, if you're buying over a unit that's already partitioned and already ready to go, then there's none. Your vacancy buffer period to fill all 6 rooms, we can either use the same 2 to 3 months, or you can choose to buy over a unit that's already fully tenanted. Total expenses works out to $5,625. Now, let's look at your operational expenses. For OPEX, utilities remain the same at $400 per month, same with your cleaning at $360. Wi-Fi, we're assuming a same $30 per month subscription, as well as your AC maintenance at $60 per month. Agent fees doesn't change, you're still gonna need them whenever you have a room turnover. Now, this is where the difference comes in. MCST fees and your non-owner occupied property tax. We can estimate this to be $600 per month extra. Your total expense per month is $1,805, and this is recurring month on month. However, if you compare it to a lease to sublease, your total time taken to break even here for a unit that you own is only 1 to 3 months. Now, let's stress test it. If one room goes vacant with a $1,200 loss, your new profit is $3,245 per month. With 2 rooms vacant, you're still at $2,000 per month. Now, even at 3 rooms vacant, you're still in the green. And on top of that, you're building equity. You have your CPF OA as a buffer, and you're backed by a real asset, something you actually own. So, let's break it down clearly. Same $8,500 revenue, but 2 completely different outcomes. For lease to sublease, your pros include your low capital entry, faster scaling potentially, but your cons come in as higher risk and fixed cost pressure with no asset appreciation. As opposed to owning, the pros include lower long-term risk and capital appreciation, as well as equity building up over time. The cons will be your higher capital requirement upfront and slightly lower flexibility. After all, you have to hold it for 4 years before you can sell it. Now, the real question isn't, does co-living still work? It's, are you doing it the risky way or the smart way? Here's where the real edge is today. Because co-living hasn't disappeared, it's just become a lot more selective. And today, success is no longer about doing more units. It's about doing the right units properly. Entry price discipline, this is your foundation. If you overpay, especially for lease to sublease, no strategy can save you, because your returns are already compressed from day one. You'll be forced to push rents higher than the market, take on lower quality tenants, or accept thinner margins. And in a competitive market like today, that simply doesn't last. So the question shouldn't be, can this unit generate $8,000? It should be, am I entering at a price where I'm protected? And what happens if rooms go empty for longer than expected? Because your entry price will determine your downside risk, your flexibility, and your eventual exit. Layout matters more than size. This is where most people get it wrong. They chase square footage, looking for larger units overall. But in co-living, efficiency beats size. You'll want minimal wasted space, clear room separation, functional common areas, low room to bathroom ratios. Because your layout will directly impact your number of rentable rooms, the privacy between your tenants, and the overall livability. A poorly designed three-bedder will feel cramped, and that creates friction and leads to higher turnover. A well-designed one, on the other hand, feels intentional, flows naturally, and keeps your tenants staying longer. Location is everything. You're not just buying or leasing a property, you're buying into a tenant catchment. And co-living tenants prioritize convenience, connectivity, lifestyle. So, what works? Walking distance to MRT is extremely important. Being near business hubs such as your CBD, One North, Changi, so on and so forth are very, very critical when it comes to filling your rooms. Being close to universities or institutions also helps with student demand, because these are your drivers of consistent demand. Without this, you'll always be fighting vacancy. Tenant profiling. This is your hidden lever most people ignore. Not all tenants are equal, and experienced landlords will know that by heart. Wrong tenants means higher turnover, more complaints, more wear and tear, and overall more management time. On the flip side, if you rent to the right people, they tend to stay longer, pay on time, maintain the space, and create a better overall living environment. So, co-living isn't just about filling rooms. It's about curating the right tenant mix overall, because stability is where your real returns comes from. Systems. This is what separates the amateurs from the professionals. Because co-living is not passive, it's operational. You'll need structure in your cleaning schedules, your maintenance workflows, your tenant communication, and turnover management. If all of this is reactive instead of structured, your problems are going to pile up. Tenant experience drops overall, and vacancy increases. And that's where your returns start leaking. So, is co-living still lucrative today? Yes, but it's no longer easy. It's evolved from a simple rental hack into a structured operational business. If you approach it casually based on old assumptions, you will struggle. But if you approach it properly, it can still outperform traditional rental. So if you're seriously considering co-living, don't just focus on the upside. Look at what actually determines whether this works: your entry price, layout efficiency, location fundamentals, operational structure, and your exit. Because co-living today isn't about chasing yield or onboarding more units. It's about holding the right asset that can perform consistently over time. And this is the reality. Not every property in Singapore works for co-living, but some are already structured in a way that gives you clear advantage from day one. Units like Simei Green or certain configurations in People's Park are good examples of this. So instead of trying to figure out everything from scratch, you might want to start by looking at what's already working in the market today. For those of you who are keen, drop me a WhatsApp message and I'll walk you through the units I currently have on hand, how they perform from a numbers standpoint, and how I would position them for both rental and future exit. That's all for today, and I hope you learned something interesting. I'm June, and I'll see you soon!